So picture this scenario. A partner retires, maybe because of old age, illness, or they just want to move on. But generally, the business itself, it doesn't just stop. The remaining partners want to keep running the firm. So when one partner leaves but the firm continues, you, as the accountant, have to step in and perfectly balance the remaining profit shares, assets, and liabilities. It requires a complete readjustment. It's actually very similar to when a new partner is admitted, but, with its own unique set of rules. Here's our agenda for today. First, calculating profit-sharing ratios. Second, understanding the gaining ratio. Third, handling revaluation accounts. Fourth, joint life policy adjustments. And finally, your ultimate exam takeaways. Let's kick things off with Section 1, calculating profit-sharing ratios, or, as I like to call it, recutting the pie. Our source material highlights a few different scenarios you're going to face on an exam. Case 1 is definitely the most straightforward. When your exam question gives zero specific details about the new ratio, you simply use the strikeout method. Let's say Alok, Bhaskar, and Shaitan share profits in a ratio of 3 to 2 to 1. If Alok retires, you literally just strike out his 3. The new profit ratio for Bhaskar and Shaitan, it's simply 2 to 1. If Bhaskar retired instead, you'd strike out his 2, leaving Alok and Shaitan with a 3 to 1 ratio. Super simple, right? You can kind of imagine the retiring partner's slice of the profit pie being removed and instantly absorbed by the continuing partners in the exact same proportions they already had relative to each other. It's clean, it's simple, and it's your absolute default if the exam prompt doesn't give you any extra clues. However, exams absolutely love to throw curveballs. Case 2 happens when the gains of the continuing partners are specifically given in the question. For example, if RF, Banta, and Chenman share at 3 to 2 to 1, and RF retires, well, the prompt might say Banta takes 2/6 of RF's share and Chudman takes 1/6. In this case, you must physically add that specific gain to their old share. So Banta's old share of 2/6 plus his specific gain of 2/6 equals a new share of 4/6. You always use the formula. New share equals old share plus gain. Moving on to Section 2, understanding the gaining ratio and really measuring that benefit. Now, what's really interesting here is how we distinguish the actual benefit a partner receives. Listen up, because here's where most students lose points on the exam. Do not confuse the new overall profit ratio with the gaining ratio. The gaining ratio, or benefit ratio, is strictly the extra fraction they inherited from the retiring partner. Why do we even need this? Because the continuing partners actually have to compensate the retiring partner for the goodwill they're leaving behind, and they do this in proportion to the exact gain they receive. You're really going to want to memorize this matrix from the source text for the exam. It tells you exactly which formula to trigger based on the specific clues given in the prompt. If the prompt gives you the new ratio, your gaining ratio is simply the new ratio minus the old ratio. If the new ratio isn't given at all, the gaining ratio is just the same old ratios between the remaining partners. And if the prompt explicitly tells you the gaining ratio, well, you just use what's given. Honestly, keeping these 3 scenarios straight will save you massive amounts of time on the test. All right, Section 3, handling revaluation accounts and adjusting the firm's net worth. You see, over the years, the value of the firm's buildings, machinery, or stock has likely changed. We use a revaluation account, which is sometimes called a profit and loss adjustment account, to determine if the firm's net worth has fluctuated since the retiring partner first signed on. Basically, we have to bring everything to its current fair value on the exact date of retirement, so the outgoing partner gets exactly what they deserve. Literally, no more, no less. So the absolutely crucial point here is that every single partner, and yes, I mean all of them, including the one walking out the door, gets their share of this adjustment based on the old ratio. This is a golden rule for your exam. If the assets went up in value, there's a revaluation profit, and the retiring partner gets their slice in the old ratio. On the flip side, if there's a loss, the retiring partner must absorb their share of that loss in the old ratio before they leave. And this completely illustrates the exact journal entry you'll need to write to transfer a revaluation profit directly into their capital accounts. You debit the revaluation account, and you credit the partner's capital accounts. Boom. Once you make this transfer, the revaluation account is automatically closed out. Let's jump to Section 4, joint life policy adjustments, essentially the firm's insurance. So many partnerships actually take out a joint life policy on all the partners. When a partner retires, the firm isn't dissolving, right? But that retiring partner is still absolutely entitled to a piece of the current value of that policy. I mean, firm profits were used to pay the premiums over all those years, so it's only fair.
When you see the term surrender value on your exam, and you will, know that this is the cash value the policy holds on the exact day of retirement. It's the amount the insurance company would pay out if the firm just canceled the policy right then and there. If the surrender value isn't already shown as an asset in the books, you have to raise it in the accounts upon retirement.
Now, the source text explicitly outlines 3 different ways a firm might be recording these premiums, meaning your exam could test you on any of these scenarios. They might treat premiums purely as an expense, they might show it as an asset up to the surrender value, or, thirdly, they might have created a specific joint life policy reserve. You really need to pay close attention to the balance sheet provided in your exam prompt to figure out which method the firm has been using. Okay, watch out, because here's another incredibly common exam trap, and it perfectly mirrors what we learned earlier. Just like with our revaluation profits, if you look at the balance sheet and a joint life policy reserve exists, you must distribute it to everyone. And yes, again, that includes the retiring partner. You use that original old profit-sharing ratio. Whatever you do, do not use the new ratio for this. And finally, Section 5, Final Exam Takeaways. These are your golden rules. Seriously, burn these rules into your memory. Revaluation adjustments and any undistributed reserves on the balance sheet always go to all partners in the old ratio. Next, the retiring partner is always owed their chunk of the joint life policy surrender value. And finally, once you've tallied everything up in the retiring partner's capital account, that final balance is either paid out in cash immediately, or, as it often happens in practice problems, it's transferred to a loan account to be paid off over time. Applying these rules systematically will ensure your capital accounts balance perfectly every single time. But watch out for curveballs, like this quote pulled straight from a sample problem in the source text. Sometimes the exam won't just ask you to figure out the retiring partner's exit. They'll add a condition that the continuing partners must mathematically force their new individual capital totals to match the firm's old total capital, based strictly on their new profit-sharing ratio. It's crazy. This requires a final balancing act of bringing in or withdrawing cash to meet those target capital numbers. So read the very last sentence of your exam prompts carefully. By treating this methodology as your personal exam playbook, you are now fully equipped to calculate the ratios, adjust the valuations, handle the life policies, and conquer literally any partnership retirement scenario your exam throws at you. So when you look at that next practice problem, which calculation are you going to tackle first? Good luck out there and happy studying.